Welcome to the Markets Happy Hour podcast, a weekly markets update for investors the world over. Each week, we discuss inflation, geopolitics, interest rates, equity markets, and other asset classes. To try to answer the question, what does this mean for my investment portfolio? Let's dive in.
These are some equity market charts, just moving to equity markets, and it has been nothing but a surge since in the last few weeks. New records being breached, and of course the concentration that has been a factor now for many months, continuing as Nvidia has now breached the 5 trillion barrier as a market cap. And I saw a chart yesterday suggesting that this now is greater than the entire market cap of all UK public companies, as well as Singapore thrown in for good measure. So clearly in a new paradigm in terms of these very large companies and just the sheer size of their market cap, and the S&P itself pushing closer to a 7,000 milestone. Of course, there is that old adage that the stock market is not the economy. And we've already raised some concerns about some perhaps cracks in the economy, but the stock market seems to be in rude health. And I'd love your thoughts on this kind of melt up in certainly the US equity markets and these really high market cap levels that we're getting with certain stocks. How do you navigate as a global allocator when a single company can dominate world markets in that way?
Well, it's a very difficult issue because, of course, at the end of the day, the US it's getting up to 70% of world indexes now. So it's a very critical part of the investment opportunity set. And, the AI boom we can see it. We can see that there's, some very real elements to this, and that it's something that every corporate has got to be thinking about how to incorporate it in their business. Ourselves as investors, some of the investment managers we use, we're all on that AI journey with figuring out, well, how do we use this thing? How do we use this thing to become more productive? Now, having said all that, the US, the S&P 500 is on about a 26 times forward PE. Asset allocators with grey hair will know that usually doesn't mean that you have a great outlook for prospective returns. And I think we always need to be very, very careful about rear window investing. But even in Australia, where we have a market that's dominated by really 4 big banks and a few resource companies and a few other sort of companies that operate in duopoly, oligopoly type situations, we're trading on more than 20 times earnings. So there's a lot of enthusiasm out there, and clearly, I think you get on later to the web of revenue between these companies, and that at the end of the day, Nvidia's biggest customers are also other players within the Mag 7. And I think there's a real question as to how this finishes up. And I think we also need a good degree of humility when we're thinking about this, because it's one where if you think about professional stock pickers, who do that for a living, they've really struggled with this. It's not been a great environment for active management. A lot of active managers have been caught on the wrong side of this, and you've seen almost as even more money has moved from active into passive. That's even fueled the fire more, with even more capital being allocated to the largest stocks in the index. Ultimately, what we'll need to see is this massive capital expenditure turn into revenue. And I think it's, if you think about this versus the last tech boom we had in the early 2000s, people do draw some of those comparisons, but then also differentiate themselves, because in the last tech boom, you didn't have the massive profitability that you do now. But nonetheless, I think for this to be sustainable, we're going to need to see this massive AI capital expenditure turn into earnings.